What happens when one of the world's biggest credit agencies says your country or company is less trustworthy with money? That's exactly what happened when Moody's downgraded the credit rating of several major entities. But what does it mean for you and the economy? Welcome to the channel. In today's video, we're going to break down a topic that's making headlines: Moody's credit rating downgrade. Whether it's a country, a big bank, or a company, when Moody's lowers their credit score, it's a big deal. But don't worry, we'll explain everything in simple language. By the end, you'll know what it means, why it matters, and how it affects you directly. Moody's is one of the top 3 credit rating agencies in the world, alongside S&P and Fitch. Their job? To analyze how risky it is to lend money to governments, companies, or banks. They give out credit ratings like or either I, very safe, or BA3, risky. The higher the rating, the safer the investment. The lower the rating, the more dangerous it is to lend to that entity. When Moody's downgrades a credit rating, they're basically saying, we don't trust you as much to pay back your debt. This can happen for countries, cities, banks, or even entire industries. Why do they downgrade? Weak economy, political instability, too much debt, falling profits, bad financial management. Once downgraded, it becomes harder and more expensive for that country or company to borrow money. Recently, Moody's downgraded the credit ratings of multiple U.S. banks and even issued warnings to the U.S. government itself. Why? Rising interest rates. Fear of a recession. Banks struggling with risky loans. This move caused shockwaves in the stock market, affected investor confidence, and even sparked global concern. When major banks or the U.S. government get downgraded, it creates fear of an economic slowdown. You might be thinking, why should I care? Well, here's how it affects everyday people. Checkmark loan rates increase. Banks may raise interest rates for credit cards, mortgages, or student loans. Stock market drops. Downgrades often lead to investor panic, higher prices. Businesses may pass on borrowing costs to consumers. Job losses. Companies with lower ratings may cut staff to save money. Retirement funds. If you have investments or a 401k, downgrades can hurt your returns. Governments and companies usually respond to downgrades by cutting spending, raising taxes or interest rates, trying to prove their financial strength to win investor confidence. But sometimes political issues or economic struggles make the situation worse. As individuals, the best thing we can do is stay informed, manage personal debt, avoid risky investments, prepare for rising costs. So now you know, when Moody's downgrades a credit rating, it's more than just financial news. It affects real people, real businesses, and real economies. What are your thoughts on this? Do you think the system is fair, or is it all just fear-driven control? Drop your comments below. Like this video if it helped you understand the topic better, and don't forget to subscribe for more simple breakdowns of complex financial news.